If you're worried about high commissions when you sell your home, there may be a larger expense that you haven't considered, and that expense is capital gains. Did you know that you could be paying as much as 40% in capital gains when you sell your California home? If you're thinking of selling a home here in California, you need to understand how capital gains works when you sell your primary residence. Let me explain. First off, I'm not a tax professional, and as you know, the tax code can be very complicated and confusing, and it will relate to individuals differently. To understand your specific tax situation or capital gain, I encourage you to talk with a tax professional. If you need a recommendation on a great tax person, send me a message or email. I'm happy to recommend one. In this video, I'm going over capital gains and how they pertain to selling a home. We'll look at capital gains rates at the federal and state level. We'll also help you understand how to calculate your capital gain. Lastly, I'll discuss some strategies that homeowners can use to defer their capital gains. Hi, I'm Vinicius Brazil with the Brazil Group and Keller Williams. I'm a top agent here in Santa Clara County, helping home buyers and home sellers make great real estate decisions. Today, I'm covering capital gains and what they are and how they'll affect you and how you can factor them yourself. If this is your first time on my channel, consider giving this video a thumbs up. And if you're interested in getting more videos about tips and information regarding real estate here in Silicon Valley, please be sure to subscribe. They say two things are certain in life, and those are death and taxes. And if you've made substantial equity in your home, you need to understand capital gains in order to factor the tax liability you have when you sell. Misconceptions about capital gains. Very often, I meet with homeowners who are shocked about the amount of capital gains they will need to pay when they sell their home. There are lots of misconceptions about how capital gains work regarding the sale of a primary residence. Much of the confusion has to do with changes in the tax code dating back to 1997, which allowed you to defer your capital gains as long as you purchased a property of higher value after you sold your primary residence. Today's tax code is quite different and only allows for an exemption for the first $500,000 in profits for married couples and $250,000 for single individual. Anything beyond those exemptions would be considered a capital gain. First, let's understand how to calculate your capital gain. Let's work through an example so you can see how one goes about calculating their capital gains. In our example, the homeowners purchased their home for $250,000 and are now selling their home for $2 million. The first step is determining your basis. Your home's cost basis is likely what you purchased your home for. Your basis could also be stepped up from its original purchase price if your spouse passed away or if you acquired it later in a divorce settlement. For the sake of simplicity, we're going to assume that the original purchase price is the basis in this example. In our first example, the homeowners purchased their home for $250,000. In addition to the basis, you can add any costs incurred to acquire the home, such as the original closing costs. Let's assume in this example, the homeowners had $5,000 in closing costs when they originally purchased their home. Next, you add any costs of improvements on the home, such as additions, remodeling, adding a heating or cooling system, new windows, landscaping, basically any improvements. Pretty much anything you add that enhances the value of your home could be considered an improvement. For our example, let's assume that the homeowners had a total of $100,000 in improvements. Next, you factor the costs incurred while selling your home, such as the commissions and closing costs. If you're curious about real estate commissions, I've got a great video that you can watch that breaks down how real estate commissions work. I'll provide the link down below. In this example, let's assume about 5% costs. For a $2 million home, that comes to around $100,000. Lastly, you add your exemption here, whether it's $250,000 if you're a single individual or $500,000 for a couple. Okay, so let's figure this out together. We're assuming a $2 million sale in the price of your home. Let's deduct all the other costs and deductions and compute the capital gain. First, we have the basis, which is $250,000, plus $5,000, which were the original costs we incurred when we first purchased the home. Next, the improvements, which are $100,000. Then the costs incurred when selling the home, which is $100,000. Since we're selling our primary residence and we're a couple, the exemption is $500,000. If we add the deductions, we come to $955,000. The difference between the sale price and the deductions is your capital gain, which in this example comes to about $1,045,000. One thing to keep in mind is that the capital gain is different than your proceeds. Your proceeds is the money you have left after the sale, and they depend on any loans that you have on the property and your sales costs, computing your tax liability. Now here's where it gets tricky. Calculating your capital gains tax or liability involves understanding your filing status and your total capital gains for the calendar year. Also, capital gains rates for the federal government and California are based on a tiered schedule where the higher the capital gain, the higher the rate. For example, for married couples who file jointly, the federal capital gains rate for the first $80,000 in capital gains is 0, so you pay no federal tax on the first $80,000. However, any capital gain above $501,601, you'll pay a 20% tax rate on that gain. For your information, here are the 2023 capital gains rate tables for federal long-term capital gains. And here is the 2023 California capital gains rate table. Another thing to keep in mind is if you've made more than $250,000 as a married couple or $200,000 as an individual, and that includes your gain from the sale of real estate, you're subject to an additional 3.8% tax. So as you can see, this gets pretty complicated. However, this video is not really designed to be able to determine your exact tax liability when you sell your home. To do that, you really should speak to a tax professional, and I'm happy to recommend one if needed. However, I hope this gives you an idea of what to expect you owe the government after you sell your home. Avoiding capital gains when you sell your home. Probably heard of a 1031 exchange. A 1031 exchange is when you sell an investment property and you exchange that property into another property. A 1031 exchange doesn't work on primary residences. It's only intended to be used on rental properties or investment properties. So it's really not intended to be used to avoid capital gains when you sell your primary residence. Another strategy that home sellers are using to avoid capital gains is the Delaware Statutory Trust. A Delaware Statutory Trust allows you to defer your capital gain by placing the proceeds in an account where you would earn interest or investment income on that amount. So if you're relying on the proceeds to purchase another property, it would not be available. For more information about a Delaware Statutory Trust and if it's something that could help you avoid capital gains, I'll provide a link down below. A couple of points I want to make before we end this video. On the topic of withholding taxes when you sell, the only time the federal government would require withholding is if you are a foreign national. In other words, if you do not have a green card or are not a citizen. California does require withholding if the property sold is not a primary residence. So if you are selling a non-owner occupied residence, expect to have the title company withhold a certain percentage of the sales price. Lastly, our tax system is constantly changing, and big changes typically happen when new administrations take over the White House. The current Biden administration has proposed raising capital gains tax on top earners. That's people making over $1 million or more. Biden's proposal would raise it to 39.6%, essentially taxing it as regular income. As of the time of this video, this proposal has yet to become law. In the last few decades, we've seen huge appreciation in our local property values. And although this is great for creation of wealth, the tax consequences are something that is rarely talked about and understood. The purpose of this video is to understand the costs involved in selling a property in order to help you make a sound financial decision when you sell your home. Although I'm not qualified to provide tax advice, I'm happy to answer general questions you may have and to point you in the right direction to get the information you need. If you would like to schedule a free no obligation phone call or meeting, please contact me directly. Thanks for making it through to the end of this video. If you liked it, please consider giving it a thumbs up and subscribe to be notified of any future videos. Until next time, I'm Vinicius Brazil with the Brazil Group and Keller Williams.